Welcome back. The phones were ringing off the hook around the country yesterday, I'm sure, as brokers were fielding calls from obviously worried investors. Now, a sell-off of this nature surprised the market, and markets don't like being surprised. Just look at that VIX. We talked about that. It was up 180% yesterday. Well, some brokers are more like managers, like in charge of putting the best team on the field. And an error here and there isn't really enough to change the whole lineup. That's how the money managers are. They're more long-term. They don't have a lot of market entries and exits. They're, slower thinkers, and they adjust their investments that way. That's how retirement accounts are run, just a little slower to react. Now, they are conservative and don't change their minds whichever way the wind may be blowing that day. That's how my next guest builds his business. And I thought it'd be interesting to hear how he's faring in this chaos. Please welcome into the show, Craig Bolanos. Craig, thanks for being on. You're more of a longer-term guy, right? You're not going to go with the wind on a day-to-day basis. How do you manage your longer-term accounts when we have real short-term volatility?
Well, there's a heck of a difference between trading and investing. And I'm not sitting on a trade desk. We're acting as a steward of people's retirement money, Scott. And if your retirement's going to unfold over 2 to 3 decades, that's the type of lens that you need. So what is action when I wake up and I see 1,000 points come off the Dow, worst market losses back to back since, spring, fall of 2022? What I remind everybody is there's a financial plan behind it. We've got ridiculously strong rebalancing protocols, and we'll find some ways to trade around positions to add value, like exiting a consumer staple to buy technology stocks that are down 20%. That's a great arbitrage, but that's the extent of the action that needs to happen because this is an economic slowdown, not the beginning of a recession.
So, I'm going to guess it was busier yesterday. You probably got there was probably a little bit of hand-holding going on, right?
We had a couple of emails, a couple of phone calls, but our clients have all been TNT, Scott. They are tested in the trenches, and our clients have done a good job over time. I think it's due in large part to our proactive communication strategy to know what is real and what is noise. Now, we all know the jobs data was real. The services and manufacturing data, that was real stuff. And certainly the market was misaligned relative to its expectations. But people know that when you're investing, you're going to get 2 to 3 dips. I call those 5% moves in a year. You're going to get at least 10% correction every 12 to 14 months. Well, I feel better. We can check the box on a couple of those now after a week's worth of damage.
And to my point in the last segment, so the Fed comes in and rescues us once again, which I'm not that big of a fan of. But anyway, no, they're not going to be creating any jobs by doing that. They're not going to create, sell any houses doing. There'll be some expectations that might be the case. But there's a lot of sectors of this economy and a big part of the economy, say 90%, I'll say maybe 80 to 90%, that are still going to be really hurting. So this might fold out. I think you and I just talked about this when we were off air. This is more unfolding over probably a 4 or 5 month period, maybe even till the end of the year, right?
Yeah, this plays out. This is not a couple of days. If you ask me in a very subtle way, do I expect the Federal Reserve to continue to act as a backstop? Yeah, but that's a discussion for an entirely different show. Do I think the VIX is going to stay incredibly elevated in the month of August, September, and October? You betcha it's going to. But if history's my guide, and it's the only guide I have that's proven to be reliable, is because the market is up for the year going into the election. Once the election coalesces, I think we're firmer into the end of the year. We just finally got an overdue growth scare, but this is just exactly that, slower growth, not full out economic contraction. So I think everybody should be using what just happened as a reminder that if you're not rebalancing your portfolio and you're getting overweight in certain stocks, certain sectors, certain industries, there's always a time to cull things back to target because it's the consistency of results that matters if you want to get retired and stay retired.
Real quick, we were on air Friday when we got that jobs number, and that's kind of what was one of the catalysts. What do you think happened in 30 seconds? Give me your 40,000-foot view.
Oh, I was disappointed. You know this. I've been betting the over on the non-farm payrolls for how long now, Scott?
Right.
So when that print came out, and more importantly, we had the revision, I'll be sincere. In fact, listen to the audio quality. There was a gasp in my voice. I was incredibly disappointed. And the only thing I know now is the Fed is going to step in under that dual mandate. The inflation target not being met, but wanting to maximize employment. You bet they are worried that companies are going to be protecting their profit margins and granting their stock options to executives because there's not going to be as many services rendered and goods sold. It tells me the consumer's under some stress, but I do think with some Federal Reserve intervention, it's going to head things off, protect the wealth effect, because it's the high-end consumer that's keeping the entire ship afloat at this point in time.
Yeah, I think a lot of what also rattled some cages was the fact that, you know what, we're not alone in this. There's the slowdowns happening all over the place. One of the people that used to help us get out of situations like this is China, and their GDP's definitely been shrinking. So we'll see. It's going to give us a lot to talk about, both on the radio and on this show. Thank you very much. Love having you on, Craig. Craig Bolanos, he's the CEO and co-founder of the Wealth Management Group in Chicago. All right.